Hi, I'm Karen Ward.
And I'm Hugh Gimber. Welcome to JP Morgan Asset Management's Markets Explained.
Your weekly briefing, where we cut through the noise and focus on what matters most for investors, setting you up for the week ahead.
Okay, welcome back. It's Monday the 13th of July. Bit of a different episode for people today. Karen's on hold, as she mentioned last week, so very pleased to be joined by Sam Witherow, our Head of Global Equity Income Strategies at JP Morgan Asset Management. Sam, thanks for joining.
Thanks for having me, Hugh.
Plenty for us to get through, I think, today. We're going to talk a bit about earnings season. Lots to unpack in terms of those reports over the coming weeks. We'll look ahead to the key events for this week, whether that's US inflation or Andy Burnham's looming coronation. But before that, if I look at the headlines this morning, they make for pretty gloomy reading, let's be frank, about the re-escalation between the US and Iran. This all started last week when President Trump said the ceasefire was sadly over, and we've seen strikes being exchanged on both sides. Also, I think notable this morning that Iranian strikes are starting to broaden again across the Gulf nations. So Bahrain, Kuwait, Qatar, Oman, all becoming embroiled again. But I do think it's interesting when you look at markets that, first of all, oil is not up by more than we've seen. We're at $77, $78 a barrel today. And for context, obviously, that's up from the lows of around $70 recently, but still well below the peak of about 120 that we had a few weeks ago. And I guess, Sam, there are a couple of ways to read this. This could be investors saying, well, this is posturing. We've seen this before. And there could be as easily an announcement to say the ceasefire's back on, and therefore people are reluctant to read into this too much. Or it's simply that people have moved on and are focused on bigger things, because in equity markets, certainly we haven't seen that much volatility, down 1-2% last week, but not big moves. So how do you piece this together at the moment?
I think there's a couple of reasons why markets are behaving pretty sanguine. Not to say it's necessarily the right outcome, but I can try and explain it. Clearly, as you mentioned, there's an element to which this is just a sort of expansion of that taco thinking. Trump always chickens out and that he'll blink, and this is part of posturing if Iran keeps sort of upping the ante. We know he cares about the stock market, and if it's in his power to protect it, the market effectively thinks there's a bit of a put. And I think the other side of it is to think about it maybe more through a sort of fundamental lens, to your point around, how much does a higher oil price actually impact global earnings power? And, I think there's a couple of angles here. One is that, we've sort of learned that oil intensity of GDP in the developed world is much less than it used to be. So oil price shocks just don't have that transmission mechanism that they used to. I think we've also seen in the last few months that the ability of the world to cope with 20% of global oil supply being disrupted out of the Straits of Hormuz is actually pretty good, because through a balance of using inventories, using excess pipeline capacity elsewhere, and then also rationing demand in developing parts of the world that frankly have less impact on European or US corporate earnings, there's a bit of a kind of we're muddling through on this type of disruption. So somewhere between those rationales, I can kind of pull together a reason why markets are staying pretty sanguine about this.
Definitely. And I think this week we'll be watching closely to see whether the negotiations that were planned to be taking place between the US and Iran do indeed continue, or whether those are parked. But Sam, to your point, I guess earnings are helping the equity market to muddle through. And this week is the real start of Q2 earnings season. We start with the banks and then move on to other sectors in the coming days. I guess tech is the first place we have to start. Semiconductors have been all over the place, to be honest, over the past few weeks. So here, what I'm thinking is kind of, what would we need to see for investors to be looking at tech and think, well, actually, this story is as good as we'd hoped? Because in recent weeks, we've had people like Samsung reporting where the numbers have been good, but the market reaction hasn't. So on tech, what are you going to be paying attention to?
Sure. So let's take a step back on earnings just for a minute. I think expectations for second quarter earnings for MSCI Acquia for them to be up about 25% year over year. That's an astounding number.
Yeah.
Outside of any kind of massive bounce off a recessionary low, we almost never see growth like that. And about half the earnings growth globally is being driven by semis. Yeah. A sector that's big and meaningful, but the fact that it's contributing 50% of global earnings growth is totally unprecedented. And I think in terms of trying to sort of understand the sustainability of this and how the market will respond to big earnings growth numbers as we head through the quarter, because those are definitely coming, by the way, I think we need to look upstream. I think it's not going to be enough for these semis companies to just sort of hit revenue numbers and give big guides. What we need to look at is the underlying health of those revenues. And there we need to look upstream at the people who are spending the money that's driving this massive semis revenue growth. And that's the hyperscalers, the Googles, the Microsofts, the Amazons of the world. What they are likely to do this quarter is massively increase CapEx guidance for the next 12 months. I mean, that's kind of been percolating out in the market over the last few months. That's partially why we've seen such strong performance from the broader kind of semiconductor group. But what they need to do concurrent with that in order to sort of maintain some degree of market faith is give us some breadcrumbs that this spending is justified, that there is a return on investment here. And some of that will come through in the shape of revenues. So certainly for the big cloud providers, we'd expect to see accelerating revenue growth from things like AWS or Microsoft's Azure. Also things like Meta's ad revenue growth. I think that hit 32% last quarter, the highest level for 5 years. Some of these companies are really monetizing this spend at scale, but we always need to see more. So a couple of KPIs that I'd be really focused on are looking for things like Google's ad revenue growth and also Microsoft in terms of how they're getting people into the Copilot ecosystem with M365. That's going to be the next leg of growth for them, and they really need to start showing some progress on that.
So sort of tracking almost one step back. So for semis, it's about who's providing them with the revenue. For the hyperscalers, it's about are they getting the revenue from their customers to be able to fund that future spend and et cetera, all the way along the supply chain.
Yeah, you need to believe in the health of the whole supply chain in order to be bullish on semiconductors here. Because if the market starts to believing that the hyperscalers are not making ROI on that, it doesn't matter how strong revenue growth the semis is today, the market will start fading that pretty quickly.
Yeah. Okay. So we keep coming back to that ROI question, that return on investment question for the tech names. Why don't we stay in the US? What about other parts of the US market? Where do you think there might be some interesting nuggets for us to pick up on?
Yeah, so while it is a very AI-driven market globally, and particularly in the US, there are interesting other things going on. So what we started to see in the first quarter was an acceleration in US short cycle sort of industrial growth. So actually, for most of the US, for the average US stock over the last 3 years, it's been a pretty tough earnings backdrop because you've been going through this sort of prolonged digestion phase of this big COVID kind of stocking effect on goods. And you've seen this huge destocking over the last few years. We think we're now through that. You can look at results from people like the rail companies, the trucking companies, the kind of beating heart of US industrial growth. We're starting to see much more of a broad-based recovery. And that's healthy for equity markets, definitely. It'd be much better if we were less reliant on just a singular factor like AI. So certainly looking for signs that that's continuing, that's further broadening. On the negative side, though, we were already worried about the low-end consumer in the US coming into this year. Q1 was not great. They've had to absorb some higher oil prices in Q2. It's possible that that's deteriorated much more significantly as well. And so that will be a kind of counterweight to that broad-based industrial strength. And in aggregate will kind of, I think, help inform the shape of US equity markets over the next 12 to 18 months.
Like it. So broadening in industrials, potentially further weakness to be seen on the low-end consumer in the US. What about closer to home? What are you going to be looking for in Europe?
Yeah, so in Europe, I think we definitely got a little bit concerned that this situation in Iran wasn't just seeping into tangible economic statistics, but it was also trying to sort of filter into consumer psyche. It is much closer to home for us. We've had to deal with another war on our doorstep as well. I think it was interesting that Ryanair last quarter really pointed out that the booking behavior of consumers had changed very quickly post-Iran. They were being much more conservative about how they were planning budgets over the summer. As that situation has somewhat improved, we'll see. It'll be interesting to see if the European consumer has inflected positively in terms of their broader outlook. I mean, Europe's been globally the sort of one relative weak spot. And I think that's partially driven by the fact that it's got lower tech weights than other regions like EM or the US, and partly driven by that ongoing kind of energy security issue.
Okay, so a close eye on the European consumer. And then to round this out, if we look further afield in China, TSMC obviously coming up later this week, some hints of some pretty strong numbers this morning. What are you going to be tracking in Asian markets?
Yeah, so there's a couple of parts of Asia I'm really focused on at the moment. One is Japan.
Okay.
Another quarter of like really positive nominal GDP growth there. I think the market's generally been behind the curve of what that means for earnings power within Japan equities, i.e. it's positive. And then on China, we've had, frankly, pretty persistently negative macro data coming out of that region for a while. House prices keep falling, and that's clearly having a very negative wealth effect in terms of consumer spending impulse. So any sign that that's starting to reach a floor, that's what I'd be pretty focused on in restaurant stocks, consumer staples, travel, that kind of thing. It's been a tough backdrop for the Chinese consumer, and we might be starting to reach a floor, but too soon to tell yet.
It's interesting hearing you talk, Sam, that lots of this is talking about some recoveries of places that are fairly beaten up, which seems somewhat counterintuitive when you think about the strength of global markets. But really, you're talking about tech still expected to look strong, but then hunting for signs really of a recovering US industrial sector, a potentially recovering European consumer, and then in China again, are there hints of recovery? So it's kind of funny that it's that way around.
If I'd come on this podcast and told you that semis were going to generate fantastic revenue growth, I think you would have yawned. The market was always looking for the next thing.
Yeah.
I think tech supply chain growth is totally taken for granted at this stage. And now we're just looking for those breadcrumbs that can persist for another 12, 18, 24 months. And really what we're trying to look for is elsewhere that give us conviction to kind of place more bullish bets elsewhere around the market.
Like it. Definitely, I think a more interesting way to track earnings season than just hunting out the big four or the big five, whatever they're called in the US tech space now. Let's turn to what else is happening this week. We have US inflation as the main macro print released tomorrow on Tuesday. Core expected to stay pretty sticky around 2.9%. Headline expected to come down, which is off the back of the fall in US gas prices that we've seen despite the latest tick up in oil. Sam, I think it's interesting that if you were one of my fixed income colleagues or an economist, we'd probably be very, very focused on US inflation today. My question here is, how important really is this for a global equity investor? Because tomorrow afternoon, the fixed income floor will be buzzing, but I suspect the equity teams are going to be more focused on earnings. So, how important really is this print for you?
I think the honest answer is less important than it used to be. I mean, for most of my career, the equity markets were very sensitive to inflation because there was a lot of duration in equity markets and there wasn't a lot of near-term growth. Today, there's a huge amount of near-term earnings growth in markets. There's less duration than there used to be. Equities aren't actually valued that expensively. The sort of bond proxy cohort of the market is a much smaller proportion of overall equities than it used to be. And so whether there is, a hike this year, a hike early next year, I mean, we're generally operating in a window that the equity market kind of broadly understands. And so I don't think there's a huge amount of insensitivity embedded to these updates. What's much more important is ongoing signals that AI is permeating the kind of consumer experience and enterprise workflows. Because that's really is what driving a huge chunk of global equity markets today.
Definitely, and I think even in bond land, with this week being all about higher oil prices so far and re-escalation, a fall in US inflation last month could still already feel quite behind the curve in terms of what's going on. And finally, we are just under 15 minutes in, and I've not yet mentioned the UK or anything to do with football, but we have Andy Burnham's potential confirmation as the next Prime Minister. It looks like Keir Starmer's final day might be this Sunday. Could he be watching England lift the World Cup as his final act as UK Prime Minister? We will have to wait and see. But with the expectation being that a week today, next Monday, Andy Burnham will be confirmed as the UK's next Prime Minister. So a final word, Sam, on the UK. Anything catching your eye, cheap for a reason, or any value on offer?
Well, I'm glad you're not going to ask me about what's going to happen on Wednesday. Ever since we knew, Labour were going to get a drubbing at the local elections in May, for the last 6 to 9 months, there's been a sort of extra discount embedded in UK domestic stocks, knowing that there was going to be probably a leadership change. And I think that discount's still there. It strikes me that as Burnham in power is probably going to be a little bit more moderate in his terminology than he's been outside of power. So, our view would be that actually, a lot of UK domestic stocks are looking pretty cheap. We hold some, across various portfolios. I think that as time goes by, we'll start to see a little bit of that discount kind of get that discount close.
Interesting. Good. An optimistic way to end then. So just to recap in terms of what we've covered, we touched on obviously the sad re-escalation between the US and Iran. I think following whether those negotiations take place will be a really important factor this week for where oil prices are headed next. On earnings, Sam, I think your message was, we know what's coming from the tech names, potentially more interesting information to be found elsewhere, particularly when thinking about the consumer across different parts of the world. And then this week, US inflation, probably less important, but maybe a little bit of offer, or I should say value on offer in the UK equity market. That brings us to a close. Thanks everyone for listening, and I'll be back next week.
This communication is educational in nature and not designed to be taken as advice or a recommendation to buy or sell any investment or interest thereto. It is based on assumptions in current market conditions and are subject to change. It should be noted that the value of investments and the income from them may fluctuate in accordance with market conditions, and investors may not get back the full amount invested. Past performance, yield, or forecasts are not a reliable indicator of current and future results. JP Morgan Asset Management is the asset management business of JP Morgan Chase & Company and its affiliates worldwide.